if you dissect what is actually going on in the bond market, bonds really have two components. One is interest rate expectations. In other words, what the Federal Reserve is planning to do with policy rates over the lifetime of the bond, here 10 years. And the other element is a more wonkish concept, which is called term premia. Now, term premia are really critical to understand, largely because we're in a new world. And I would say this is a new world which is dominated by capital flows and liquidity, where term premia really matter. If you look at the data since 2010, something like 90% of all variation in US government bonds, to take one example, have come through term premia changes, not through policy rate expectation changes. And this is a dramatic change. If you look through history, it's normally about 50-50. So there's been a real skew to say term premia are important. And what are term premia really representing here? They're pretty much representing the excess supply or excess demand for coupon bonds. And what you're seeing in the black line on the chart, which is looking at term premia, is there is a secular increase in the trend of term premia upwards. So you're seeing these term premia in the US continually going up. This is probably a testimony to the fact that issuance is likely to expand. And because of that prospective increase in issuance, investors want some protection or yield cushion against that. In other words, the excess supply of bonds is going to increase, and therefore yields will have to increase. In other words, prices fall to clear the market. And that's pretty much what that's saying. Now, before we get hung up on the US to say this is, the end of dollar supremacy or the end of the US Treasury market as a safe haven, which is what the media love, of course, to say, that really is, complete bullshit, if I can say that. The fact is that if you look at this following chart, this is looking at daily term premia from the beginning of this year. And what we've done is we've singled out the US in red here, and we've plotted it alongside what's happening in Japan in black, in the French oat market, which is the dotted orange line, and in the German Bund market, which is the solid orange line. Now, what this data pretty much confirm is actually it looks as if the US may be the cleanest shirt in the laundry here, because you've seen an increase in US term premia since January 1, but actually the increase net is about 10 basis points. What you've seen is something nearer 40 basis points going on in the Bund market. You've seen 25-ish basis points increase in French oats and in JGBs, and that really is the problem. So what you're seeing is the US is no longer necessarily a price maker in global bond markets. In this instance, is actually a price taker, and yields in the US are being forced up because of what's happening elsewhere. Now, we can see this in the following chart very clearly, and this is the change in the policy regime that you've been witnessing in Japan. Now, the Japanese bond market is unusual because yields have been so low. And if you look at the chart, what I've drawn on that chart is the actual yield on the 10-year JGB bond in the solid orange line. You can see that actually went negative in 2016 and then again in 2019. So you had negative yields on the JGB bond. The two shaded areas are looking, first of all, at the QQE period of support, which was called qualitative and quantitative easing by the BOJ. And then the other policy that they enacted, which occurred from 2017, which was yield curve control, explicitly trying to keep the yield on the JGB down. Now, as that policy has ended, so you've seen the fair value on the JGB start to increase, but more specifically, the actual JGB, the orange line, has started to move back very quickly towards that fair value target. And the fair value target, the broken orange line, is at about 2 percentage points. So you can see that from a starting point in early 24 of almost half a percent, 50 basis points, or maybe a tad more, let's say 70 basis points, what you're seeing is a very significant increase in yields in Japan. And it looks as if from this chart, they may have another 50 basis points to go. And that's really what we've been witnessing in the very long bond, the 40-year bond in Japan, which is yields are moving up with some alacrity now. And I think what people are realizing is that all these governments have got a fiscal situation which looks parlous, and it's getting worse because of demographics. To evidence that, you've got a third of the Japanese population which is now over 65, and that aging population is going to keep going. For example, I came across a wonderful statistic the other day which said that a woman born in Japan in 2007 now has a life expectancy of a whopping 103 years. I mean, that is just unbelievable. So Japan's demographic problem and the burden of old age and welfare payments is going to keep going, and they're going to have to keep issuing debt or somehow monetizing this debt to afford things, and that's really an issue. Now, this is the story in Japan, but we're looking at a similar case globally. And actually, if you look at the US, this is a chart which is intriguing, which really shows the mess that is also going on in the US bond market. The orange line here is the 10-year treasury yield again, rather like the previous chart. But what I've put on this chart is a different calculation, which is looking at what is called a bootstrapped 10-year bond that I've calculated from the mortgage market, the mortgage-backed security market. Now, that market is government-backed. It's effectively a risk-free security.